We're entering a phase in the crypto market that feels unfamiliar, not because the volatility is gone, but because the drivers have changed. This is no longer the Wild West of ICOs or the casino of meme coins. This is about infrastructure, integration, and something much bigger than just another hype cycle. Crypto is evolving. Bitcoin, in particular, is transforming from an outsider asset into a core building block of the traditional financial system. That shift is subtle to most, but to those paying attention, it's the most important signal of this cycle. And it's just beginning. We've seen institutional interest before. In 2020, during the last bull run, institutions talked about Bitcoin. But this time, they're building with it. They're integrating it. They're creating products around it. The difference is night and day. This brings us to a powerful insight shared recently by on-chain analyst Willy on X. The post reads, "The biggest fintech opportunity in the next decade is not DeFi. It's the merger of Bitcoin plus TradFi. 2014, Tether was the first. It'll make more money than the top 5 banks put together in 10 years. 2020, Microstrategy became next. 700x growth in 5.5 years so far. More incoming. At first glance, this may sound like another bold Bitcoin take. But let's unpack the implications. In 2014, Tether quietly became the first large-scale bridge between fiat and crypto. What started as a niche stablecoin is now a revenue machine, generating billions in profit from US Treasuries alone. It has evolved into a quasi-central bank, printing digital dollars on demand, plugged into global crypto rails. Think about that. A company with no branches, no physical infrastructure, and zero regulatory clarity is on track to out-earn JP Morgan, Bank of America, and Citigroup combined. Then came Microstrategy, the first publicly traded company to pivot its balance sheet into Bitcoin. In 2020, they began accumulating BTC as a treasury reserve. Fast forward to now, and their strategy has returned over 700 times, not in some obscure altcoin, but in Bitcoin. And the vehicle wasn't a token. It was a NASDAQ-listed software company that simply front-ran the playbook everyone else is now scrambling to understand. While the 700 buy figure is not directly reflective of MicroStrategy's stock performance, it does highlight the exponential impact of its Bitcoin strategy on the firm's core identity and financial profile. In reality, since its first Bitcoin purchase in August 2020, MicroStrategy's stock price has increased roughly 10 to 12 times, a rare feat for a public company, in under 5 years. More notably, the market value of Bitcoin held per share has surged far more aggressively, transforming MicroStrategy from an enterprise software firm into the de facto Bitcoin proxy in public markets. So what do these examples tell us? They reveal a blueprint. The merging of Bitcoin and traditional finance is not just a story of adoption. It's a new asset class being born in real time. One that offers the regulatory certainty, liquidity, and capital depth of TradFi, with the monetary properties and scarcity of Bitcoin. The market is waking up to this. BlackRock's Bitcoin ETF wasn't just a product launch, it was an opening salvo. Now, pension funds, sovereign wealth funds, and asset managers can gain exposure to Bitcoin without touching a private key. That removes the last barrier. But the real power is in what comes next. Corporations integrating Bitcoin into their balance sheets. Banks settling internal ledgers on Bitcoin rails. Tokenized treasuries backed by Bitcoin reserves. And yield-bearing stablecoins with Bitcoin as collateral. Every traditional institution that integrates Bitcoin, either directly or through wrapped financial products, injects not just capital, but credibility, demand, and long-term stability. These aren't short-term traders. These are allocators with 5, 10, 20-year horizons. And as this structural capital flows in, Bitcoin's volatility dampens over time, even as its price continues to rise. It becomes not just a speculative asset, but a core monetary instrument, one with digital finality, global access, and no counterparty risk. What we're witnessing is a Cambrian explosion of Bitcoin-native financial products, and that's what Wu is really pointing at. The idea that the biggest gains ahead won't come from gambling on the next hot protocol. They'll come from spotting the institutions that successfully embed Bitcoin at the heart of their financial model. Just like Tether. just like Microstrategy. The next 700 by opportunity won't look like a flashy altcoin. It may look like a boring bank, or a fintech firm with a Bitcoin treasury, or an ETF issuer with early Bitcoin exposure. The surface won't scream crypto, but the underlying strategy will be soaked in it. This is what makes the Bitcoin plus TradFi merger so powerful. It's not about destroying the old system, it's about upgrading it, quietly, from the inside out, and the window is still open. Willy isn't the only one connecting the dots. Other Bitcoin thought leaders are reinforcing the same thesis, just from different angles. Like Michael Saylor and Raoul recently made very bullish tweets about Bitcoin and the general trajectory of the crypto market. Saylor's tweet simply reads, "If it's not going to zero, it's going to a million." Though Saylor directly mentions 0 and a million, his prediction for the largest cryptocurrency is more nuanced. He's not saying Bitcoin will hit exactly $1 million. He's saying that in his view, there's no middle ground. Either Bitcoin fails completely, becoming worthless, or it succeeds massively, becoming the dominant store of value in the digital age. Think about it like this. Gold didn't become kind of valuable. It became the global reserve asset for thousands of years. Saylor believes Bitcoin is on a similar path, but better, faster, and digital. So why a million? That number isn't random. It reflects a future where trillions of dollars move from weaker assets, like fiat currencies, real estate, and even gold, into Bitcoin. As more institutions adopt it, more nations embrace it, and inflation erodes the value of cash, Bitcoin could absorb that capital and skyrocket in value. To Saylor, betting on Bitcoin is like buying early internet real estate. If the network effect continues to grow and confidence compounds, there is no ceiling. And if that doesn't happen, well, it all goes to zero. It's an all-or-nothing bet. And Saylor's all in. Raoul, on the other hand, is more concerned about liquidity and its impact on crypto asset prices. His recent tweet reads, "Keeps trucking along, doing its debasement thing. If 89% of all Bitcoin's price action is explained by global liquidity, then by definition, almost all news and narrative is noise. Enjoy your weekend." Founder of Real Vision and one of the most respected macro thinkers in the space, has been saying this for years. Bitcoin is a macro asset, and its price action is overwhelmingly driven by one thing: global liquidity. That's the essence of Pal's view. Bitcoin isn't reacting to stories. It's reacting to the flow of capital, the expansion and contraction of credit, and the net liquidity environment created by central banks and governments. When liquidity rises, meaning more dollars, euros, yen are circulating in the global system, Bitcoin rises too. Not because of hype, but because it is mathematically hard-capped in supply, and demand rises with available capital. Raoul's thesis has always been clear. Bitcoin is the purest expression of macro liquidity. It's the fastest horse in the race when central banks inject capital into the system. In that sense, Bitcoin isn't just a hedge against fiat debasement. It's a monetary truth serum. When liquidity surges, Bitcoin moves first and hardest. He's backed this with data. Real Vision's Global Liquidity Index, which aggregates central bank balance sheets, reverse repo usage, and cross-border capital flows, correlates with Bitcoin's major moves to a staggering degree. In fact, as Pal noted, close to 89% of Bitcoin's price action over time can be explained by liquidity. That means almost every narrative you hear in the news, whether bullish or bearish, is a distraction from the real driver. From Pal's lens, Bitcoin isn't just a technological breakthrough, it's a macro trade. A high volatility, high beta asset tied directly to the liquidity cycle. And that cycle, as he's pointed out recently, is turning again. You don't need a new narrative every week. The macro setup is already in place: rising debt levels, slowing growth, aging demographics, and the need for perpetual monetary easing. The long-term direction of liquidity is up, structurally, and Bitcoin, as Raoul sees it, is the best long-duration asset to express that view. So when Bitcoin keeps trucking along, as he puts it, even when headlines are chaotic, it's not luck, it's liquidity. If you missed Bitcoin at $100, if you missed Microstrategy in 2020, this next wave may be your second chance, but only if you know where to look. Stick around. We'll keep following the capital, the tech, and the institutions rewriting the financial system with Bitcoin at its core, and we'll bring you the insights that matter most before the rest of the market catches on. Don't forget to like, subscribe, and share your thoughts in the comments. Which company do you think will be the next to bet big on Bitcoin and win even bigger? Thanks for watching.